G'day there. If you've got a HECS or HELP debt and you're wondering if perhaps you should be paying that debt off a little bit faster or whether you should be putting that extra money off your mortgage instead, then this video is 100% for you. G'day there, my name is Phil McGilvray. I'm the founder of the Money Boss Academy, where we make practical, life-changing financial education both understandable and accessible for everyday people. And today we are talking HECS debt and mortgages. Which should we pay off first? So what I'm going to do is take you through how HECS actually works. And then I'm going to talk to you about the difference between paying off your HECS and paying off your mortgage as it stands right now. And then we're going to look at some pros and cons for why you should pay off one over the other. Now, to help us through this process, I am going to walk through a case study with Dave and Kayla. Now, these guys are very real clients of mine that have been working with me since 2013. Now, I catch up with them now every quarter because their budget is nailed. They're doing a great job on their mortgage. They're doing really well with every aspect of their finances. And the question that came up this time was, Phil, Kayla's back at work, starting to earn a bit of money. Should I use that money to actually pay off our HECS debt, or should we use it to pay off our mortgage? So I wanted to share with you their situation just to give you some context. So these guys are 32, 33. They've got a mortgage of $170,000. They're doing a great job of paying that down. They've got interest rate of 6.2% on that mortgage at the moment. Kayla's income, she's just started back working in school hours, $22,000 per year. Dave's is $142,000. Kayla's got a HECS debt of $25,000, and they've got two munchkins aged 4 and 7, and very soon both those munchkins will be at school for full-time, or as full-time as school hours are. Now, before I look at the specifics of them, what I want to go through is, well, how does HECS debt work? So the first thing to understand is that HECS gets paid back through your income. So it's an extra tax that is taken from your income. So I will say to you, please make sure if you've changed jobs or you're starting jobs that your employer knows that you have a HECS debt, because they will tick that in their system, and then every payday they will take out some of the HECS debt so that it's just evened out throughout the year. If you don't do that and you get to the end of the year and you lodge your tax return, you're going to end up with a nasty tax bill. So please make sure that your pay team, your employer, knows you've got a HECS debt. Now, if you're earning less than $54,000 though, you don't have to pay any HECS debt. Repaying your HECS debt only kicks in, and this is in the 24-25 financial year, so the one we're currently in, only kicks in if you're earning above $54,435. And at that point, between $54,000 and $62,000, 1% of your income will be taken to pay back your HECS debt. And you can see here that as you earn more, a bigger percentage of your pay is taken to pay back your HECS debt. So that's the first thing that you need to know. Until you earn $54,000, you don't have to pay any HECS. And in fact, if you never get to $54,000, and bearing in mind that this $54,000 gets indexed every year, it increases every year. If you never reach this figure, then what happens is you never have to pay back your HECS debt. In fact, your HECS debt will die with you. Your family members won't have to pay it back. It won't be passed on to your estate or anything like that. It will die with you. Okay, so the next thing we need to look at was, how does indexation, or in other words, the interest on my HECS debt actually work? So historically, your HECS debt each year has gone up by whatever the rate of inflation or consumer price indexation was. So over the last 11 years, the average has been at 2.48%. However, as we all know, over the last couple of years post-COVID, things have got a bit silly in terms of the cost of living. And as a result, you can see the CPI in 2023 was 7.1%, which scared a lot of people, because what happened for many people was that what was added to their HECS debt as interest, or the indexation, was more than what they paid off all year through their pay, which meant that their debt went up despite the fact money was being taken from their pay every week, which is a little scary. That happened to my daughter Hannah, and she was knocking on the door going, "Dad, what's going on here?" But what the government is doing is they're realizing that they can't use inflation as the sole figure for indexation in case inflation did suddenly spike up again. So what they're looking at doing is including the wage price index as another measure for indexation, or as another tool for indexation. So what they'll do is take the lowest of whatever these two figures are each year. So we can see that in 2023, if it was 7.1 for some consumer price index, but for wage price index, it was only 3.7. So if they used the 3.7 instead, you would have, well, Kayla with a $25,000 HECS debt would have been $850 better off. But we can see that there's been times where, so you can see where there's a red figure, it means that the wage price index was lower. But when there's been a black figure here, it shows that consumer price index has been better. So across the course of 11 years, you can see that it's been a bit of a mixed bunch. So by using both, it just means that you should end up with a much more stable indexation of your HECS debt. So hopefully what happens is we return to these long-term averages where CPI long-term is 2.48% and wage price index long-term is 2.3%. But that's yet to pass Parliament. I just wanted to give you an idea of how indexation works so that we can determine, well, do we want to pay our HECS debt off faster? So the next thing that I want to look at is, well, what happens if I don't pay off my HECS debt? Well, it's very simple. Every year that indexation will be added, so the interest will be added to your loan. And so you can see, if I use this example here, I've used a long-term average of CPI, which is around that 2.4%. We can see that year one, 25,000 would turn into 25,620. And next year that would grow to 26,256, and so on. And if we look at the course of that over 40 years, you can see in 40 years' time, that debt will be worth $66,652. Now, of course, the bigger your debt, the faster this is going to look like it's compounding, which can be very, very scary. So obviously, the goal I would suggest, unless you know you're never going to work at all, is at some point to pay it off. But the question is now the time to do that? And is now the time to do that for David and Kayla? So if we have a look here at their situation again, should we pay off a HECS debt? Just a quick reminder, we've got the mortgage of 170, interest rate on the mortgage is 6.2. Kayla's only earning 22,000. So she's a long way away from that threshold of earning 54,000. Dave's is 142. Kayla's debt is 25,000, and they've got the two kids. So the question is, do we pay it off? Well, the first thing that I want to talk to you about is the interest rate comparison. So if we have a look at this, you can see that indexation applied in the 23-24 financial year was 4.7%. Okay, so that was the year after the 7.1. It's slowly coming down. It's back to 4.7. However, if that legislation to include the wage price index goes through, this will be dropped to 4%. So that's quite a bit lower. And I suspect that will actually pass. If, however, we look at the home loan rate, the home loan rate is currently 6.2% for Dave and Kayla's mortgage. So that's a 2.2% interest, which means that it's a $550 difference on $25,000. So financially right now, if we just purely look at the numbers, it really doesn't make sense for them to be paying off their HECS debt over and above their mortgage right now. But let's have a look at a couple of other reasons why they might not pay off their HECS debt at the moment. Number one, we've just covered it. Interest rate is currently higher on their mortgage than the HECS debt. Number two, Kayla is currently not meeting the minimum income threshold. She's nowhere near it, and I would suggest that she's unlikely to be anywhere near it for at least the next 5 to 6 years whilst her kids are going through primary school. The third reason here is that we've sat down and identified that based on the new income that Kayla's bringing in now that she's back doing some part-time work, could allow them to pay off their home loan inside the next 4 years. And so that would give them an incredible goal to try and get that knocked off, so that once that's paid off, they are literally freeing up for themselves $4,000 to $5,000 every single month that they could be using for all sorts of things. They could be using for their kids' education, they could be using it for holiday overseas, they could be using it to renovate the house, they could be using it to buy a bigger home. But it would open up so many options for them to have that much money available to them once their home loan is paid off. And of course, they could use that $4,000 to $5,000 to knock off their HECS debt very, very quickly once the mortgage is gone. So that for them is a big goal right now, and something that we sat down and we worked through just how quickly they can get it paid off, and it's a real motivator for them. And so I think most people are more motivated about getting their home loan paid off than they are their HECS debt. And so I think go with the one that gives you gets you most excited. The fourth thing then is flexibility. When we pay money off the mortgage, potentially we can get access to that money again. So if we're ahead on our mortgage, we can, if we've got a redraw facility set up, or if we're popping it into an offset account, we still have access to those funds. Money that you pay off your HECS debt is no longer available to you. It's gone. So from a flexibility perspective, especially if we're uncertain about what the future might bring for us in terms of work, in terms of, potentially wanting to stay at home more with the kids and so on, it just gives you a lot more flexibility to do those things. Okay, so let's have a look now why Dave and Kayla might choose to pay off their HECS debt early. The first one, peace of mind. Having multiple debts out there. It's one thing to have a home loan because, people often look at the home loans and go, well, I'd be paying rent anyway. But having another debt there can be quite stressful. So just knocking it on the head, getting rid of it so you've only got one debt to worry about, if that gives you warm fuzzies and helps you feel a real sense of peace of mind, then I would encourage you to think about paying off that HECS debt. The second reason you might want to pay off your HECS debt, or Dave and Kayla might want to pay off their HECS debt, is if you're worried about future inflation. We saw indexation jump to 7.1% following COVID. It was 4.8% last year. If you're worried that perhaps inflation could take hold and those numbers could get bigger, then by all means, go ahead and pay off your HECS debt. Now, of course, the government is trying to temper the impact of inflation by including wage price indexation into the equation. Now, that hasn't passed Parliament yet, but it looks like it will. If that gets through, then that will help reduce the risk of inflation becoming a big issue, but you just don't know. And then the last reason here that you might want to look at paying off your HECS debt is that when you are going for a home loan, so let's just say Dave and Kayla were moving to a bigger home to accommodate their two munchkins, let's say that was happening, then having that HECS debt there does actually get included in the overall equation when the bank looks at you and says, can you afford this mortgage? Just be mindful that with the HECS debt, it will get added into that equation and it might affect your serviceability for getting a new home loan. So none of those are relevant for Dave and Kayla. They're not too worried about the HECS debt right now. They're not too worried about the inflation, and they've got a home. They're not planning on refinancing. So none of those really apply to them. So in their situation, as we've gone through the numbers, they've come to the conclusion that paying the home loan off first, especially if they can get rid of it inside 4 years, is going to be their focus, and they will deal with their HECS debt later. Now, there's one more thing that I want to finish with here. Before you tackle HECS debt or debt of any kind, there's a process that I'd really encourage you to go through. This is the roadmap that I use with all of my clients to help them get their finances in order, to help them get a real sense of peace of mind about their finances so that they know where they're at financially right now and they know where they're headed. And there's 3 steps, and you can see if we go through here, paying off debt is actually step number 4. So there's 3 steps before we get to that. The first one is making sure that your income is greater than your expenses. There is no point trying to pay off debt if right now you've got more expenses going out than income coming in. Because what's going to happen is you'll pay off the debt, then some expense will come up, you don't have the money for it, so you put it back on the debt. And that can be very, very frustrating. So making sure that your income is consistently greater than your expenses. The second thing there is then making sure that you've got money set aside for your known upcoming expenses first. So make sure you've got the bills covered. Make sure you've got money set aside for the groceries. Make sure you've got money set aside for health. Having some kind of budget in place so that you've got your known upcoming expenses covered. That is really important. And then step 3, and this is the one that people often miss, step 3 here is having a rainy day fund so that when the unexpected turns up, when the dog gets sick, when the fridge dies, when you need to go to the dentist for root canal therapy, all of those things come up from time to time. Every year, at least 10% of expenses will be those sorts of expenses. So do it right. As I said to you earlier, my clients have paid off $18 million in debt over the last 7 years. The system that I use with them works, and it starts with this. Income's got to be greater than expenses, a budget to make sure you've got your known expenses covered, a rainy day fund to make sure you've got your unexpected expenses covered, then you can tackle debt, and that includes HECS debt. Okay, so if this has been helpful, can I invite you to click the like button and subscribe to this channel? As you know, I'm on a mission to make practical, life-changing financial education both understandable and accessible for everyday people, and by clicking the like and subscribing, it helps me reach more people. If you know someone that has a HECS debt, please share this video with them because they might find it really helpful in the decision-making process. But take care, and I look forward to seeing you in the next video.